Welcome everyone to the Kendall Report. It is Monday night. Well, we didn't have quite the disaster that everybody was thinking about. We did see some positive movement last night, and we had some pretty good follow through early in the session, but the volatility today was wild, as I'll show you here in a few minutes. It was amazing. If you were a trader, it was an amazing day if you got it just a little bit right. And one of the things, and I'll talk about this again tonight, but we've been seeing this over and over and over, and I keep bringing this up, is if you're coming in really strong or weak into the open, you can fade that first hour or so. So I'll point that out, and there's some great trade setups there. So hopefully some of you, especially those of you who've been in the live room, are taking advantage of some of these situations that are out there. There were some nice trade setups today that you should know quite a bit about. So let's talk about what's going on. I mentioned last night I really was, I would say, mitigating any kind of major risk here. I continue to see this. Just real quick before I'll make a couple mentions here. We'll go through some of the expectations for tomorrow. Then I'll get into talking a little bit more about what's going on here. But let's go ahead and do that first. What's the big thing tomorrow? CPI. CPI is expected to be up 0.5 year over year. It's supposed to be at 6%. Last report, the previous was 6.4. So we're continuing to see inflation moderate. And I'm going to try to make sense of what's going on in the markets here in just a few minutes, because we saw, interest rates just plummeting. In fact, just for the record, and I'll go through more details, is that the drop in interest rates has mitigated most of the risk in the banking system. And just by it dropping as fast as it did, all those depreciating numbers that everybody's been throwing around on the banks are dissipating very quickly. So I'll talk more about that in just a few minutes. But I think the rhetoric coming out of the government is very interesting as well. We got even Joe to come up, and of course he screwed up the statement, right? So I think he said that basically all deposits at every bank in the United States are now guaranteed. That is not what is guaranteed. What's guaranteed are just the bank signature and, of course, SBV and Silicon Valley Bank. That's it, okay? But they are making a reference with this bank term funding that is going to support any bank that has issues, that has the collateral to put up to get there. There are a lot of small banks that don't have the collateral or the configuration to hit that discount window, but many do. So of all the folks that are out there, we're really looking at not that many banks. I think I've been talking, I have been collaborating with a number of friends and people out there just trying to make sense of what's going on here with the banking system. And I continue not to believe that there's a big contagion that's going to occur out there. It's not going to roll over. I'm going to correct some of the things that I've been talking about with Charles Schwab here in a minute as well. But there's, when I look at the world from Bob Kendall's viewpoint, from our algorithms, from everything that I'm doing, I'm just not seeing the end of the world happening here. And it was pretty impressive. Especially the rally on the NASDAQ was huge, and today it's only a market that finished higher on the day, up 0.45. S&P was down 0.15, but we saw some crazy. Like I said, we'll go through all the details here on the technicals here in a minute. But the reality is they've pretty much mitigated this whole situation, in my opinion. I think it's kind of a one and done. I think you can start looking in the rearview mirror and watch this stuff pull away. I don't see the whole banking system rolling over in that. And it was interesting because we we saw a lot of selling in the banks again today. There were plenty of sellers out there, and they're continuing to do that. I would think that there's going to be some pretty good opportunities. As I talked about last night, not all banks are bad banks, but they're being played right now as if you're a bank, you're bad. And it's a classic scenario that I talk about all the time. The markets can't chew gum and walk at the same time. They're all focused on this one thing. And I think what we'll see here tomorrow with CPI coming out, of course, on Wednesday we get PPI. We're going to start to look forward, I think, a little bit more and look at some of these other reports. We'll see how it all sets up tomorrow, but that's more or less what I see here. I do not see the contagion. People are spending way too much time talking about what's going on. I guess it needed to be discussed, but I think you're pretty much seeing it. Like I said, I'm calling it one and done. SPV, Signature are really the two. It's interesting that all of the failures are all S banks, right? You got Signature and Silver, and you got Silicon Valley, right? All of these S companies are the ones that have gotten hit. Just a real quick, there's some really bad numbers floating around on Charles Schwab, and I think it was maybe purposely to get the algos going, but there's been some rumors that their ratios are a minus 171%. Kind of went through things today. I went through some things with Dr. Jim Baker, and we looked at this, and Jim has discovered, I won't go into detail, but we did go dig into this situation pretty good, and it looks like it's still not good, by the way. It's still a minus 40, between minus 40, minus 50, I just rounded off, but it's not 171. It was literally the worst bank out there, and it looked like the end of the world. And I was quite concerned. A lot of our institutional accounts are clearing with Schwab, and I don't see the risk that I put out on a tweet earlier today. So I think it's a little bit different. Going to watch it really closely, but I don't see it as material. One of the other things I'm doing right now, especially for institutional clients, going through all of the clearing firms, just seeing if there's anything I can detect that there's any kind of dislocation capital that's happening that would put any of these custodians at any type of risk. And I'll probably talk about that over the next couple of sessions, because I think those are the things that you have to watch for in this kind of environment. But we'll see. I think a few more days of the bank noise, and it will start to dissipate pretty good. We'll see. That with this kind of environment, it's dynamic. We can really get things going. We saw a huge bid in Bitcoin. It saw a huge bid in gold, even bigger than I thought. I thought there'd be some flight to gold, but we were up, I think, $51 at the end of the session on gold. So that was a big number, to say the least. Just looking at my notes here, I just, like I said, I just don't see the contagion. I said it multiple times. I'm still stuck on also the scenarios that I've been talking about, where I don't see the recession coming. I don't see this big rollover in the economy. I think this noise that hit the market was pretty ugly. I went through a lot of detail. If you didn't watch last night's video, then go back and watch it tonight, because basically what was going on there and what I covered is I went through a lot of detail, and like I said, there's no further contagion. I'm going to stick my head out on here. I don't see the big recession coming down the road, and I think this drop in yields will be short-lived, but it's broken a lot of patterns. And I'm going to spend a little bit more time on the yields tonight, and possibly we'll get into the yield curve a bit, because all of a sudden things have changed drastically within a couple of days. I think they'll readjust, but these patterns have been broken. So let's go ahead. Let's go. Should be able to get through tonight's video fairly quick. Let's go into the Wavetech database and just get into the rest of the broadcast. So here we are in the daily database looking at 12.96% bullish, pretty low. I think we'll probably end up maybe liquidating underneath the 10% level, get into single digits. That's something I talked about last night. This basically is a full liquidation. We only have 2,000 symbols long of the 15,773. So it about as liquid as you get here. So we don't really own much. Last night, for tomorrow, we have 819 sell signals, 796 buy signals. So we're starting to already see that rotation where we have equal number of buys and sells. So we'll see what happens, comes out of tomorrow's action. But I already see the short-term database start to normalize here. What we should see sometime probably in the next 3-4 sessions, maybe it'll be into next week, we'll start to see some buying coming back in if we get some stabilization, and then we'll see the short-term database get back over 22, start to head into some of those metrics that I talk about often, 22, 28%. So we've got to rebuild the castle, so to speak. It got torn down. And the intermediate, as I covered in last night, the intermediate database continues to be pretty bullish at 58%. So for right now, we're just looking forward on the database, and it looks like on an intermediate, this should rotate through. I do expect us to see potentially a little more attrition depending on how this week ends up. Now, we had quite a bit of action, as I talked about last night, and as far as the S&P goes. So let's go ahead and get into the technicals here. All right, so the S&P, this is the hourly chart here, is looking really flat. Looks like we could get a little bit of push up into the, you know where, the London Open. Probably get some stabilization coming into there. I think, like I said, there's really nothing here to look at on the short-term basis. That the algos are absolutely flat. There's no acceleration here. So what we end up with maybe and this is the I believe the June contract here, and we're looking at the ranges of 3904, 3923. Last trade here is at 02. So we're just trading right in the sideways range. If we get above the 40, 3923, we could see some interesting numbers come out there. So let's look at the daily. And a daily is definitely starting to, looks like tomorrow we should start to turn up and maybe challenge the 10-period moving average. That's 39.59. We'd have to get above that area to really get some things going here from that standpoint. But the patterns that are out there look to me like they're starting to stabilize already. We came right down toward this fib target 1, 38.21. We did print down to 38.39 low and bounced a bit out of there. If I blow this up just a little bit, just so you can see this, yesterday's bar, we had a huge bar, the range all the way from 39.71 to 30, let me get the right number here. Yeah, 38.39. So we had a 140-point range yesterday, and it basically went through the whole spectrum from starting higher to trading all the way down and then all the way back. I put a tweet out mid-session. We printed down around S3, and I said we should rebound back to R1, R2, and I believe we hit R1 on the rebound, and that was a huge number because that was about 80 75 to 80 handles on the upside there. So yeah, so it depends on what contract you're looking at. If you're looking at the June contract, 3809 was the low. This is the June futures here. Yeah, if we put up the other one, we'll leave it there. But let's go over to let's come over here and we'll take a look. I believe, yeah, you'll see here's the June again. Let's take a look at the expectation for the market grid. We're looking at, so far we're looking at 38.99 last trade. We've had a 38, 39, 39. This is yesterday's values here. 1 second. This is weekly. That's why. Okay. I thought these numbers aren't making sense. Here we go. Let's try this again. So far the range has been 38.90, 39.05. So pretty narrow range, 15 handles. And we're looking at S1 38.62. So I would expect to see at least an S1. And the possibilities there, just looking at what we're reviewing, the hourly chart, 39.45 is probably the range we're going to be. We're also seeing the expansion of the volatility right now. And typically we should see this range start to contract over the next couple of days. We do have two major stories coming out, major releases with CPI, PPI. I do expect, actually, I expect them to be more positive than negative. I don't see any big surprises on the inflation front right now. In fact, I expect to see more moderation. Whether it's enough to make a difference, then we'll see how that goes. But the pattern is set up here is starting to get this volatility, and we could end up getting what I call a volatility bubble. It's very similar to what happens in Bollinger Bands, but these are based on a completely different calculation. Instead of standard deviation lines, these are direct volatility lines that will start to change, especially if we get above and we get above a certain level of volatility, and then you'll start to see them expand quite a bit. So like I said, we've got a couple reports coming out, and my expectation is that we will have more positive to the upside here than negative. I don't, like I said, don't see a surprise on the CPI numbers coming out or the PPI. I think they're going to be somewhat supportive. And then and I think ultimately, once we get beyond all of this junk in the banking system and we start to see more stability, I'm sure there's going to be some stories that come out that is going to concern some folks. But for the most part, I do expect to see this whole thing just kind of quickly move into the rearview mirror, or let's say it's on the front page of the Wall Street Journal. It'll be on page 20 pretty quick. Say over the next couple of weeks, we'll wonder what all the hoopla was about. I just don't see the contagion happen. I know I've said that about 10 times. If you said how many times did he say contagion, I think it's about 10. Let's go back to TradingView and let's review the algos here. Like I said, on the dailies here on S&P, there's some positive view. We still have some potential downside to pull back in. Part of it's because of this angle of attack on this 10-period moving average here. You'll see it's coming down fairly steep here. That's going to supply some pretty good resistance at 39.63, and that number is coming down about 7 handles per day. So all of a sudden around 39.40, 39.30, 39, that goes in line with those expectations of the market grid for tomorrow. We should start to see that. I don't think at the moment we see these downward Fibonacci targets, these red dots down here. Basically, we satisfied that yesterday in that volatility. So I do expect, like I said, S1, R2 for tomorrow. All right, looking at the NASDAQ. NASDAQ looks like it's got a bit more positive. We saw it finished up, like I said, NASDAQ cash was up 0.45 on the session while everything else was down. We do have some resistance around the 12,182. We printed all the way up to 12,222 yesterday. Don't think we get through there. There's quite a bit of resistance up here. If we look at the market grid for this tomorrow, it's over on the far right. We're looking at S1 11,902 and R2 12,101. So I think we stay within that range. Don't think we get through yesterday's high. And it looks like, just like with the S&P, that as we come into Wednesday, we're probably going to peak out, maybe fade into the end of the week. I don't see anything drastic. We'll see what kind of setups we get over the next couple of days, what type of action we get out of the markets. But for now, looks like stable, slightly up. Looks like probably the 200-day moving average in here is going to be a pretty major support here. Let me just get that number for you. It's 11,933, and we should stay above that number. That maps out pretty good with the S1 number that I talked about earlier. All right, so we've got the Russell. Russell was just really getting hammered. There was a point in time where it looked like it was going to be stronger. That's not the case. We've traded all the way down through the lower fib targets, going back when the market was over here and it was printing. Let me get some numbers for you. When these first numbers came out, was back on February 23rd. We got these fib targets on the downside. 1791 was extreme. Well, we printed all the way down yesterday, down to 1722, and a little bit of a bounce coming in. There is a pivot in here right now. Number to watch is 1780. We get above that, should set up some positive tone there. We just look at the volatility's gotten huge here on Russell. So S1 1759, S2 1801. So we could see a little more volatility, maybe trade back up toward this 200-day moving average from that's at 1835. Let's move on and get into the treasuries. There's a fair amount to talk about here. As we look at the treasuries, it's pretty amazing. I mentioned that if we got through this 364 level, we could print down to 3.25. And we printed down yesterday, we got to 341, call it 342. And the high was 354. We went out at 351 at the high of the session. We managed to close just above that 200-day moving average here on the yields. That was pretty drastic. There's still plenty of downside, but what you're seeing here on the algos is that these moving averages are starting to roll over. And I'll just draw in a couple here. I want to make sure that you see this. And let's just so what's happening here with the 21, this moving average is going to roll over here. And then we'll get the 10-period moving average to come. Will start to come down here, and then the 40 will come in here. So what we're likely to get is the market starting to move back into this range. And this number right here, I'll get that number is that 364 number will initially be some resistance out from a yield standpoint, but that ultimately should get broken and we start to set up some sort of pattern over here in this range right here. We'll set up some sort of pattern that is going to end up maybe setting up something like this, and then we move back into the range. It should be fairly volatile in here. The algos are all suggesting downside, but really what they're forecasting is that the moving averages are going to come down. The markets should move back up. The yield should move back up toward these values here as we go forward. Let's take a look and just go to the futures real quick on a 10-year. You can see, remember, this was a number I was touting out there. If we broke above that, we'd probably go to the 200. Well, we did that, and we that number was at the 112.20 and a half, and we printed all the way up here yesterday to 115.13. So we broke all the way up to this 200 period moving average, just to get that up there real quick. That number is 114.15. So we traded above it. We're back below it. I think we come back toward, on the futures, we'd probably come back to 113.12, something like that in this pattern here. So we should pull back, just like I was saying. You see this the setup a little more it's easier to see looking at it from this way, but we should see these moving averages move up, and the market should move back down. So as this goes down, rates will be going up just slightly. We should stabilize here somewhere. This 112.20 number is going to be a key number, just like the 364 number on the 10-year on the yield will be similar. So let's go, and what I want to do here is I want to show you something here, and this is what has been significant. This is the spreads here, and the spreads are, you can see this is the 10-30 spread. Look at this spike, just crazy. You were seeing a steepener. Same thing here with the 13-week versus the 5. I believe I'm just going to verify the data here, and just so that's the 13-week against the 13-week versus the 5 here. So you can see how this is basically a 13-week coming down substantially. So we really steepened all of these yield curve substantially, and this is my point when I'm discussing that the yield curve is, this steepening is actually helping all of these depreciative assets. So what we've seen by coming back into, we didn't stay there long, but let's just say 350 on the 10-year. And if you look at all of these securities that are being held on the banks, everything from a price standpoint improved substantially. You just saw the futures. That reflects what prices look like. So that was a huge element. Now, what's interesting about it, the markets did this there was a lot of demand for treasuries, people going to safety. Obviously, you see that in gold. You see that here in the activity here in the interest rates where everybody's buying treasuries. That's going to dissipate if I'm right, and we don't see any further disruptions, any kind of further bank failures, those type of things. Listen, there's going to be little banks. I made a comment earlier while we're still on interest rates that these smaller banks that don't have access to a discount window, there's going to be probably some more fatalities. It really depends, though, on what happens here with the yields and whether they stay above a certain level. And I'm gonna use that 360 level as a high water mark, where we come back to around 364. I said 360, but 364, 365 is going to be probably a high water mark for the moment. So we're at 351, probably move back toward those levels, and then we get range bound and a lot of consolidation while this conversation goes on, because there's going to be a lot of talk about everybody's going to be still focused on the banks. And it's interesting. I don't know that the hedgies are going to be able to push this thing down. They were definitely, if you go back Thursday, Friday, and today, there was a lot of pressure, downside pressure on the indexes. Tomorrow night, I'll go through something. We have Wavetech, on the database, we have our own indexes, and I'll show you tomorrow night what's going on with those indexes in the financial sector. And they're not as devastating that you'd think the end of the world was happening in the financial sector. And we have very broad indexes. I think there's around 540 symbols inside of that database. And it's different. It's not weighted. It's completely different than all the indexes you're going to see out on the street. We constructed them much differently, and I'll review that tomorrow night. I think that'll be worth taking a look at. But all of these spreads, folks, what you're looking at here is a good thing. This is about as good as it gets. This is what needed to happen. And it's interesting, like all the Fed did was, on last night's video, liquefy the market. They basically made it available that anybody if you have ability to get to the discount window, which is a lot of banks, by the way. I think there's only about 18 banks out there that are really in big trouble, but they're small banks, and none of the big boys, none of the money center banks, none of this stuff is an issue. So this is somebody, I think I saw a comment, was even on Twitter or here before I started tonight, is this 2008? No, it's not. In 2008, I'll just go on for a minute. 2008, we had a bunch of really bad assets on a book of banks. We had mortgage loans that people weren't able to pay. They were defaulting everywhere. All of that stuff that was going on then was really, really bad, much different than this moment. This moment has something completely different. And the sad part, and I'm really disappointed, I spent a good portion of my career working with banks specifically to help them manage that gap risk, that risk between that mismatch of yields that happen on the balance sheet. And, it's very disappointing to me that so many banks got so, I just have to say they got complacent, because why they don't have good hedging programs on. I started in 1979 in the market. Just a really quick perspective story. I worked in a room in 1981, that what we were doing were pitching banks on hedging the risk of their portfolios. And, I wouldn't say I personally wasn't an innovator. I was part of that was going on, because we were trying to help banks to fill that gap. So things like what we just saw with Silicon Valley wouldn't happen. And there are a whole lot of things. I could spend a whole stream just talking about all the things that could have went different and all the reasons. And I did go through that last night, why SBV should not have happened. And it was just kind of ridiculous. And it's almost as if, I'm going to call out, if you look at our governments, you look at the infrastructure of just about everything, everybody's gotten even really complacent, or there's just no talent out there. I mean, I'm an old guy. I'm 70 years old. So this is stuff we were doing, 40 years ago, literally 40 years ago. And, it fascinates me. I always kind of look at the markets. Just a quick comment here. I look at the markets that we're sophisticated. We got these derivatives, and there's so many smart people, a bunch of you young people out there that know how to use this. And I'm thinking, maybe not. It looks like maybe that art form is not there. So anyway, what we're seeing though is a good thing, and it's probably good. Since they weren't hedged, this is the best thing that could happen if a lot of people were unhedged. So we move on. All right, we'll go to crude next. With all the noise out there and all the expectations of people talking about recession and everything falling off the rails. No pun intended there. But what we're looking at here on crude, the algos look like we're going to firm up over the next couple of days. We'll probably come back in the range. We traded down almost to this fib target 2. It was 7. Let me get the exact number. 70. The low yesterday, 72.30. Fib target 2 was 71.51. So we came just short of that. We went through fib target 1 and we bounced back, and we're seeing not anything big going on here tonight, but I think we end up coming back into maybe an R2 or so. Let's look at this. R2 is 77.78. We should see this come in. And in real terms, I'll draw this in just because this, I haven't talked about it for a few days, but I want to just bring this up. But this is where we are. We're still in this box here, and that's all there is to it. We are locked into this range here, which we've been in for going all the way back to December. This is a daily chart, so we're just continuing in here. And what you really are, the goal is, are we going up, or are we going to follow through on the downside? I suspect we do more of the upside, and probably this 200-day moving average is going to be one of the key levels. I'm not going to go into the weekly tonight, but this is just this pattern we've just been locked in for months now, and there doesn't appear to be any escape at the moment from these patterns. Even though we traded down a little bit in the lower pattern, the algos are suggesting we're going to stabilize. In fact, PPM2 is turning up as of tomorrow. So we'll see if we can trade back in the range, but you're going to have plenty of resistance right here at these moving averages, which are, let me just get those numbers up here for you. 77, 17, 77, 12. You've got a bunch of stuff right up here around just around 77, even 77.50 should be an extreme in this pattern. All right, so next we'll take a look at gold. Gold just exploded out of here. I think this starts to fade back into the pattern. We should come back toward the 40-day moving average. That's around 1880. I'm kind of shocked. I expected to get up toward this upper end here of the 40, right around the 1880. But to print up, yesterday we printed 1919. That was pretty overdone. I am going to bring up, I'm going to zoom out just a little bit here because I want you to see this. There are Fibonacci targets I haven't talked about for a while, and they continue to be valid. And we're looking at the potential here for 2000, 2077, 21, 22. These are very big numbers. This is off a daily chart. But what's happening here, and I've talked about this for a while, a couple things. I'm just going to blow this back up, just keeping those numbers in mind. I'm going to draw in just one more thing here just to make sure we're all looking at this at the same thing here. But this is the pattern that's projecting this right here. This is where these numbers up here are coming from. These are the Wavetech indicators that you can get on TradingView. If you're new to the channel, you can go there and go to kendallreport.com/indicators, and there's some information there how to get them. But these algos are picking up these patterns. And I just want to point out that over here we picked up this pattern, and this was way back. I don't have the exact date, but this was the pattern that was being projected into this range right right here. This is where they were being projected. We went right to it. If I brought up the numbers, we went exactly to these projections, and they were occurring about 6 weeks ahead of time. So now we're getting these new projections, these stair-stepping projections, and they're probably going to be hit, at least that minimum number. That 2,000 number is very likely. And, we're a couple more days like what we had. I don't expect this to happen. If you look at the algos here, looks like we're stalling a little bit here, but what's happening is these moving averages, the angle of attack is still up. So we're going to have support that's going to come in around the 1865 level. So we're trading I believe 1880. I'm not sure this skews everything. Let me get this off here so we can get back to a live quote. Yeah, so we're at the 1911. Like I said, we should come back toward this 1880 level. 1865 would put us back around the 10-period moving average. This number's coming up. So that's going to be your support. And depending on, it looks like we've got some nice upward slope. All the moving averages are coming in underneath here. We're probably about 3 or 4 days away from the 10-period moving average crossing over the 40, and the 40 is 1880. So that's the next event I would look for, is for the 10-period moving average to cut through. That'll be solid support. Like I said, 65, 80, 1880 down to 1865 is going to be really solid. There's two other things that happen here. As we got this bubble, this is that bubble bottom that happened there. And that is, I believe, was a significant event. I talked about this going back a few weeks ago. I'm going to flip this over to a weekly chart just so you can see these numbers as well. But weeklies are suggesting, even though we traded up here up to 1975, if we go back into January, so we're just setting up the potential here. Draw in one more thing, and then we'll move on to Bitcoin here in just a second. But the potential here, we haven't gotten the confirmation yet, but is going to be a pattern like this, and it would be signaled. We take out this 1975. There's some big numbers potential on the upside, up to 2,400 plus on gold. And I'm not sure. I guess this is the big dilemma that is going on here from the standpoint of the markets. Here is the dilemma is, is this an inflation hedge? I don't think it is. I think more of a fear index. Maybe there, for us to get to there's things that are going to have to happen down the road that would bring the gold bugs out at that level to bid this thing to the numbers I just mentioned. So for now, it's more consolidation with an upside potential on the upside. Interesting. Somehow the sound got turned off. So thank you. for that. I'm glad I looked over there. So yeah, so as we look at Bitcoin, the weekly is actually the place to look here. I mentioned the other day that we're talking about 618 was a high, but the market grid was suggesting R3 24,558. So we printed R3. RTX is 25,216. And so that's coming up right there at 24,618 is a high. So we probably continue up there, but here's what's happening on the weekly. Looks like we're very close to losing some of the upward momentum here on the weekly, but it's still going to be positive. So the number to watch here in the Bitcoin pattern on a weekly is going to be a simple 10-week moving average, 22,903. That number is going up about $700 per week. So that's going to put us at 23.5, 23.6 is going to be support. And the only thing that's looks like it's going to happen is the 21 period moving average is going to turn up in this pattern, and it's probably going to stay bullish. We may end up going to this rising 200 week moving average, which right now is 27,000. That could be a thing as we come in to next week. Let's go over to the dailies. And this will be interesting because we're breaking out on the dailies. Dailies are suggesting there's more strength to the upside, probably looking at that upward RTX on the weekly numbers that I just mentioned. And that should be probably the top end at 26.3 or something like that. But there's actually a decent uptrend formed here on the dailies. Everything's starting to turn up. So there's going to be multiple days, which doesn't look like this rally is going to fade very quickly. Okay, folks, sorry for the sound situation. So anyway, just to kind of summarize, I'm looking at some of the things that you folks are talking about here. Yeah, like no one knows what the markets will do next. Not Bob, me definitely, not his indicators. Hang around for a while, you'll learn a lot. Yeah, so yeah, I've got a lot of experience with these indicators, like 35 years. So you'll see. The database is still long, 58%, and yeah, you'll hang around for a while. You'll see a little bit. You must be new around here. Yeah. So FF, to just answer a few questions here real quick. Is the dog still wagging the tail? Yeah. Listen. There's a discussion that can happen here, and I think one of the elements that there has been some new thought coming in with this banking situation, but I do, like I said, I've said it again, I think it's highly isolated. I don't see it as material. We're not in 2008, and there's nothing to even compare it to at that point in time. I can tell you the emotions, those of us that lived through that in 2008 was really intense, and I'm certainly feeling a lot of those feelings from back then. But it's really there's no comparison. And like I said, the fact that the 10-year and all the interest rates adjusted so quickly in 3 days, this is a big deal. Now, if they spike back up and all of these numbers, hopefully, these folks are smart enough to hedge up that gap. That's why I went into that little talk a little bit ago about, there's an opportunity to eliminate these risks. And I'm still shocked that we find ourselves in somewhat of a material way that people meaning the banks weren't hedging this risk factor. At least now they know it's there. The question is, do they have good facilities which to authenticate those type of strategies? Hopefully so. Like I said, 40 years ago, we were doing this stuff. I spent a big part of my career doing this, and I'm shocked that the markets were caught that flat-footed. Especially, really, the Fed caused a lot of this from the standpoint they were forcing banks to hold these securities. There's a whole, the way the balance sheet has been looked at. Won't go into that tonight, but the way the banks have been shuffling the chairs around on the deck, on moving things on the balance sheet, basically cooking the books so that they didn't have to have some things marked in the market, some things were. They've really moved a whole bunch of stuff, especially the big banks. So there's some games being played, and all they really had to do is put some hedges on, and they could have fixed a lot of this stuff. Anyway, folks, I'm going to call it quits for tonight. Thank you so much for hanging out. Sorry I got a few minute late start tonight, but we'll see you tomorrow night, same station, same time. Thanks again. See you then. Thank you again, Smurfs.